Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Today, we are joined by Morgen Peck, Portfolio Manager, to discuss value investing, opportunities in international markets, and how the team behind Fidelity Global Intrinsic Value class co-manages their fund. Morgen begins by describing Global Intrinsic Value as a co-managed fund that benefits from multiple portfolio managers, specializing in risk evaluation and idea generation. It is a value fund with a quality tilt, aiming to offer strong downside protection during market drawdowns while keeping pace during upswings through quality stock picking. She then notes that there are currently numerous opportunities in the smaller and mid-cap segments. Looking internationally, Japan is highlighted as a key area being undervalued and containing overlooked public companies. Morgen also uncovers other hidden gems they're finding and closes off by going in depth with the fund's contingency plans. This podcast was recorded on July 9th, 2024.
Hi, Morgen. How are you?
Hi, Pamela. Nice to see you. Thanks for the time today.
Lovely to see you as well. We mentioned team. What's the team?
Absolutely. I'm happy to walk you through the team. So the fund is somewhat unique within Fidelity in that it's co-managed. I co-manage the fund with Sam Shamovitz. Solomon Hart is also part of the team, and he uses his quant model to intersect with our fundamental ideas. And he really helps us determine position sizes. Just as a reminder, Sam and I have been co-managing various funds together for over a decade. And the best way to think about us is that we're really an investment committee of two. So together we decide which stocks to own, as well as the sector and geographic tilts. Together we decide when to trim or sell a stock, and we're together constantly evaluating the risk exposures on the fund. But it's also worth noting that we lean into the advantages of having two PMs, and the area where we split up to try to take advantage of that is on idea generation. We really think that it's beneficial to have two pairs of eyes scouring the globe for new ideas. And it may be interesting to note that I just spent the last month working in our London office. Sam's currently in Tokyo. Solomon is also on the road. And so we're all sort of out there trying to find new ideas. And we bring each other into the fold pretty early on once we identify an idea, and we're constantly pitching ideas to one another. So that's how I describe the team.
That's amazing. Love to be a fly on the wall, but I'm glad that you're joining to tell us about part of it. Tell us a bit about, there's a lot of different opinions on where the markets go from here, and a lot of different opinions of what you need to, depending on who you are and what you're investing for in your style zone, what you need to be either exposed to or protected from, a little of both. Tell us about the style of this fund.
Sure. So the way that I would describe our investment style is this is a value fund with a quality tilt. So the fund is always cheaper than the benchmark, but it's also higher quality, which we think is a really neat combination. And what that means is throughout the cycle, the fund provides really strong downside protection during market drawdowns. But then through good stock picking, we do our best to keep up in up markets. Through cycle, the goal is really to produce strong returns for shareholders with less volatility and in a way that behaves differently than most other mutual funds. So we think it's a really good complement to the tech and Mag 7 heavy portfolios. The other thing to note is that our investment approach is very long-term oriented. So we're thinking about the longer term through cycle free cash flow power for the companies we own, and we're evaluating what those free cash flows are worth. And then we're constantly comparing that to the price. So we don't manage the fund with a strong future view of where the market is going. Instead, we're trying to find where maybe too much news, bad news is priced in, and we can take advantage of those types of opportunities.
Because of, and you're saying you're not looking necessarily at what the market is doing, but I'm going to ask you about this anyway. Yeah. Does the value story at this moment in markets tend to be with smaller cap companies? Or is that, I mean, I know it's an oversimplification, but are the companies small? Because the massive ones are the ones that you just mentioned. Maybe this fund would be a complement to those. Like the big funds are the Magnificent Seven, are the companies that you're looking at by nature of what's going on right now, just lower cap.
Yeah, so we are definitely finding more opportunities if you go down the market cap spectrum. And maybe just to highlight for the audience, I think when a lot of people talk about quality names. They're thinking of, the Mag 7 and a lot of these technology companies, and valuations are pretty stretched there. So quality is a bit expensive in the larger cap parts of the market, especially in the US. Where we're finding opportunities is, to your point, down cap in the smaller and mid cap parts of the market. We're finding opportunities both in the US and globally. And it's interesting to note that because of our quality tilt, we're really focused on the profitable parts of the market. One interesting tidbit is that for the Russell 2000, which is the sort of the benchmark for the US small cap universe, about 40% of that universe is unprofitable. We don't look there. That's not the area where we spend time. If we zone in on just those profitable names, both in the US and globally, valuations are actually very attractive, anywhere from 12 to 14 times. And that's the market, the profitable small market. And we're finding names that are even more attractively valued. So it really helps to have the research breadth that Fidelity has for us to find names fit the process. We are finding more of them down market cap.
Just to sort of follow up with that, when there are opportunities that are a bigger company that has the value qualities that you're looking for, that also happens. I mean, is there anything to sort of dig into there?
Yeah, so you'll definitely see, if you look across the fund, we do own companies sort of across the market cap spectrum. And the way that we think about that is, while most of the time we're looking at small and mid companies, that tends to be where most of the market inefficiencies are. We do find opportunities both up cap and down cap. So in the micro cap space, as well as in the large and mega cap space. And when there are really big dislocations, and we tend to see them in more cyclical parts of the markets, like the more cyclical parts of consumer discretionary, financials is another area. That's where you can see some larger cap companies become very dislocated from our estimate of fair value. And because of the opportunistic nature of the fund, we are then able to take advantage and own names like that. So that's really how the fund comes to be. We take advantage of the fact that we have that flexibility, the ability to be opportunistic. And that's how you get sort of a range of market cap companies in the fund, but most of the time we're in small and mid space.
Let's go around the world a bit. You mentioned that you spent some time in England. It sounds like it was right around the election, so there was a bit of a frenzy there. So take us there, but also just the international tilt more broadly. Yeah. So begin wherever you like, but it just sounds like England was timely.
Yeah, absolutely. So just to remind everybody, the fund does remain underweight the U.S., so we're overweight everywhere else. And that positioning has been in place for a while. And as a reminder, just to put some numbers to it, the U.S. is about 60 to 65% of the benchmark, and we're underweight by about 1,700 basis points, or 17%. And so we own U.S. in the fund, but it's just a smaller exposure than the benchmark. And as a reminder, similar to the commentary on market caps, the geographic tilts are really a function of where we're finding the best opportunities, where we're finding those dislocations between price and value. It's not a top-down macro view of a particular country or region. But to answer your question, Pamela, on the UK, the SMID space in the UK, those stocks have been under pressure for the past few years. This is part of the reason why I really wanted to go sort of spend a month there, meet with a bunch of companies just to see what's going on. And I think a few reasons for some of the pressure on this space is that the UK has kind of been in the doldrums due to a lot of the negative aftermath from Brexit. The region has been experiencing slower growth because there's been less investment in businesses, reduction in labor supply. The weaker currency has led to higher inflation, and that's reduced living standards. They've also had a string of pretty erratic leaders like Johnson & Truss. There have been pockets of adverse regulatory developments. And so understandably, UK retail investors have increasingly been allocating capital overseas. And we've actually been seeing a number of our UK names, they're trying to relist outside the UK. So that's a tough backdrop. But what makes it interesting to us and what the opportunity is, first, with the new Labour government, they're expected to be a bit more pro-business. So hopefully that at least provides some stability now that the election's over. And then the FCA, which is a regulatory body, they're trying to talk about ways to simplify the UK listing structure. So if you layer that on top of the fact that valuations in that part of the world are around 11 to 12 times, again, I'm talking about profitable small and mid caps, that's a really interesting part of the market. And when I was in London, I met with about 20 companies over the course of the month. And we found a lot of great ideas. A few names that are in the fund, have been in the fund for a while, that we think are great examples of opportunities in the UK. Are pets.com. This is an omni-channel pet accessory retailer. They provide pet services. And another one is Direct Line. They're an auto insurer, and they're undergoing a really nice pricing reform.
I mean, 11 to 12 times just sounds like a world away from what some of the valuations are, obviously, in the U.S. that we've been talking about. Tell us just a little bit more about what is the catalyst for these companies to be trading at a higher earnings, forward-looking earnings ratio. I mean, what gets you off 11 to 12?
Well, I think part of it is, the company, I mean, this happens every time we find companies where we think there's a difference between price and value. I think particularly in the UK, there's just a lot of, negative macro news. But I think that to the extent that the companies we own have, they're higher quality companies, they've got more control over their destiny. We've met with all the companies, all the CEOs and CFOs multiple times. So I really think it comes down to them executing on their plan, delivering on the earnings and free cash flow power that we think, they can ultimately achieve on a normalized basis. And part of our process, Pamela, is really just to remain patient. I'm not going to opine on when, valuation gaps may close, when that difference between price and value closes, but we've gone through this enough times in enough markets that patience typically pays off. So to the point before, if we've got a little bit more stability on the macro side, I think that could go a long way to the extent the companies are continuing to execute.
And is there a move of flows out of the U.S. because some valuations have gotten so high? I mean, do you see that as part of the story?
No, so far, from all the data I've seen, the flows into the U.S. continue pretty strongly, and flows out of the U.K. are also continuing. And so, that I don't know when that's going to change, if it's going to change, but I do think some of the regulatory changes the FCA is trying to push through may give UK investors some reassurance that perhaps they should be looking at some of the companies in their backyard, right, like the ones we own.
Fantastic. Tell us a bit about Japan. You mentioned that Sam is there, and I know he's spent time living there over the years as well, as I recall. Japan's been a big part of the fund, Japanese companies, for actually, a very long time. Paint the picture for us.
Yeah, absolutely. So you're right. The fund is overweight Japan, and that overweight's been in place for quite a while. We've liked Japan for a long time because, as you know, there are thousands of public companies. Many of them are undervalued, they're overlooked, they don't have great coverage, and many of them also have, good quality characteristics. One area that we do wish would have improved for years has been that of corporate governance, and specifically responsible capital allocation practices. What's interesting is that on the heels of the Tokyo Stock Exchange, late last year, requesting companies that are trading below 1 times price to book, so very cheap companies, the TSE asked them to formulate a plan to improve capital efficiency. And so what we're starting to see is improved corporate governance moves for a lot of companies to try to address their overcapitalized balance sheets, unwinding cross-shareholdings, and also publishing specific ROE targets with supporting strategies for that improvement. So we're actually seeing these plans coming out from companies, which is really exciting. We're also starting to see companies increasingly return free cash flow to shareholders. Even in the last couple months, with many of the names that Sam's actually meeting with now in Japan, they're talking about returning free cash flow to shareholders through buybacks and increasing their dividends. And then the next stage that's even more exciting is to see that moves towards balance sheet efficiency. And so I think a great example of this is a small cap name, Yuasa Trading. It's a small cap Japanese industrial trading company. They're like a wholesaler. This is a business that produces, north of 20% ROICs. It's trading at less than 10 times normalized earnings. And they recently announced an increase in the dividend payout, and they're starting to buy back shares. So that's just an example of the type of opportunities we're seeing in Japan.
It's so interesting because it sounds like sort of the pieces of the quality story are there in other countries, but just don't have the expensive price tag attached to them, really. Yeah.
That's exactly right. We're usually able to find, just as good quality companies at much more attractive valuations outside the US.
With that said, let's go into the story of earnings. In the U.S., it can also be abroad, but we've got the very, very, very beginnings of earnings for the second quarter. Starting up here, what is it that you're looking for in terms of signals, in terms of, maybe you don't want to look at all of the macro stories, but there must be certain things that you're hearing from company leads that plow into how you're going to invest?
Yeah, so I think that maybe just to take a step back, the way we think about earnings season is really an opportunity to check in with our companies, to try to get a sense of, our investment thesis. Is it on track or not? Have the company fundamentals changed? Is there any reason that the thesis is cracking or not? So regardless of the macro environment, the things we focus on during earnings are really trying to understand, is our investment thesis for each company still intact? And what is the company worth? Because usually when they report, there's movement with the stock price. In terms of data points and what we're looking for, to your point, Pamela, we're not super focused on, an outlook on the macro. And we are very, very early, like first inning on earnings season so far. But, the early data points that we're hearing anecdotally from companies is, increased pressure on the consumer, especially the low-end consumer. And so, I guess one thing Sam and Solomon and I have been talking about is just parts of the market, especially in the US, don't seem to be contemplating the risk of recession. And so, that's an area that we're focused to the extent that the consumer is under pressure, under increasing pressure. That's an area we're continually digging in on. But in most cases where we're seeing, opportunities are in more cyclical parts of the market where maybe a recession is priced in. So there's a lot, if you sort of, pull back layer of the onion, you can see, parts of the market not pricing in a recession, parts of the market are, but with the data points on the consumer, this is an area we're continuing to focus on.
Okay, really interesting. And is the consumer story similar in other countries? I mean, we don't have to sort of make a blanket statement across the world, but is it something that you're watching in the markets that you're in?
Yeah, I mean, we're absolutely, given in, many economies, the consumer is a really big driver of underlying growth. We do pay attention globally, and I would say just very broadly, it can vary a bit market by market. But, while inflation in most places has stabilized, maybe it's starting to deflate a little bit, cost of living is still very high for many consumers. The majority of consumers who are at the lower end of the income spectrum are still feeling a lot of pressure. So broadly, that's what we're seeing across the globe, but it does vary region by region.
Take us into within some of the sectors. You're looking very specifically, obviously, at different companies within, but if we were to sort of chunk out the financials, within that, how do you take a look at some of the segments of that sector? Maybe we'll talk about other sectors as well. I think you had mentioned insurance to us earlier at some point. Sort of break down the sectors and what you might look for within and maybe keep the macro noise out.
Yeah, I think generally speaking, I'll talk about financials. Within financials, the biggest part of financials is going to be the banks, and then insurance is another big chunk of it. And you might appropriately ask, like, how can you own financials, which aren't exactly equated with quality? But we do think about quality in sort of a different way within financials. If you think about banks, for instance, banks are a commoditized business. They are price takers. They don't have a great, deal of visibility into their cost stream, which is, future losses. Those are hard to predict. But we found opportunities for banks that are what we call sort of the higher quality banks. So these are banks that have, very attractive deposit bases. That's particularly important after what we saw with, the banking crisis last year. Companies that have a prudent history on underwriting, so they're very responsible in the types of loans that they underwrite, the terms and conditions. We're looking for banks that are in a very strong capital position. And very importantly, a key part of our process is trying to focus on companies that have responsible capital allocation practices. And that's particularly important for financials. So within that context, combined with the fact that the banks had sold off quite a bit last year and valuations remain pretty depressed across the globe, That's an area where we have been spending more time. A lot of these banks we think are trading, kind of less than 10 times our view of normalized earnings. And we think that they can generate mid-teens ROEs in a more normalized rate environment. So that's how we think about investing in an industry that perhaps is not deemed high quality. I won't go through all the detail for insurance, but it's a similar story where we're trying to find companies that have carved out some sort of niche and they've got a good history of underwriting, trading at discounted valuations.
There's a couple of questions coming in. So one of them is, again, this is sort of a broad geopolitical question. So Morgan, what concerns you? Any geopolitical issues on your radar?
Yeah, I mean, there are so many cross currents that we are paying attention to, again, to the point we don't manage the fund with a strong view of some future macro or geopolitical outcome. I think if I had to talk about the geopolitical tensions that I worry most about, clearly the risk of sort of what's happening in China and risk of Taiwan, like that's a concern for me. I think just the ongoing land wars that you're seeing in Europe and the Middle East, those are, areas where we're continuing to focus on. So as we assess the companies that we own, we're always trying to think about that risk, especially because the fund does invest globally. We do think we've got companies that can sort of, thrive in any environment. But those are the areas where we try to really, as we think about risks of investing outside the U.S., those are the sort of the risks we think most about.
Okay, we'll swing back to just a couple of sectors. Let's take a look at energy broadly, maybe oil within. And again, I'm not sure if that's a story that's, of more interest in somewhere like the UK, where they have a lot of that on their stock exchange, but maybe trading at different multiples. But tell us about the energy story for you.
Sure. So the fund remains overweight energy, and it has been that way for a while. So some of the overweight is in the large global integrateds, names like Total and Shell. We really think that those companies they have done and are continuing to do a really good job navigating the global energy transition. They're making intelligent investments both in traditional and newer energy forms. We think that adaptability is going to allow them to remain relevant as the energy transition continues, even though we don't know the pace or exactly what it's going to look like. We think that they've got, the ability to sort of manage through that transition. But the overweight in energy really came to be over the past few years when we saw some big dislocations across North American E&Ps. That tended to happen when you saw big pullbacks in oil and natural gas prices the past few years. And those commodity price, pullbacks, they were either due to some sort of large macro concern, but it also was happening around a lot of, negative sentiment on the space as it relates to the energy transition, right? The worry that these companies weren't going to be needed in the future. But in our mind, we saw free cash flow yields north of 20%. That was pricing in a lot of bad news that we didn't think was fair. And so while we absolutely think about the energy transition and the eventual risk to the fossil fuel energy complex, we think that the natural gas E&Ps, which is where we have the biggest overweight, is going to benefit from natural gas and LNG likely continuing to be bridge fuels for years to come.
Yeah, that bridge term is used a lot and really interesting for sort of medium-term investment, it seems. Tell us a bit about AI. I think that fits into sort of this idea of where perhaps some were deemed as winners or losers. It can kind of fit into that overall bucket with the natural gas story perhaps in there. Is there something beyond that? And I know you mentioned that Salim is helping with many parts of the fund. He always has helped run it, but there's an AI component that he's looking into quite deeply, I think.
Yeah, so maybe if I just talk about AI from like how we're thinking about it and from an investment perspective, and then I can talk about it how maybe we're using tools as portfolio managers. Obviously AI is evolving in terms of what it means to different companies. I think right now we're still in the learning curve. There's still a lot that we're trying to figure out how AI is going to impact the companies that we own, and clearly that is what we're trying to figure out on a daily basis. Today, most companies that we talk to are using AI as some sort of productivity tool, but it's in pilot phase. So it hasn't really been launched yet broadly across organizations. And so that's sort of how we're thinking about AI. We are not trying to find the next hot AI theme. We're really just trying to understand how AI is going to impact the names we own positively or negatively. And Pamela, to your point, it seems like every time there's a new emerging trend, and in this case, AI, the market is really quick to categorize names as winners and losers. And like, you can't be anything in between, and valuations tend to move extremely, positively or negatively. And across the fund, we have some companies in the AI winner bucket, some in the loser bucket. And so what we're really doing is trying to understand, okay, there's been a big price move. Do we think the earnings power and the free cash flow power have changed for these companies? And if, some of the AI winner names have become too richly valued, then that's where we'll trim, and vice versa for the loser bucket. To address your question on sort of how we use AI sort of on our day-to-day, I think a great example is that Solomon and the quant team, they use this large language model to score previously written internal research notes. We have so many of them at Fidelity. But the model basically develops sentiment scores on a lot of uncovered stocks, especially ones that are smaller caps. So it was a great way to try to find some new ideas. And I would just say that AI is also being used to try to help us as portfolio managers get through earnings season a little bit more efficiently. We're using LLMs to try to summarize the earnings calls, and that can help us prioritize on names where earnings were probably really different than expectations, and that's where we should focus.
Okay, fascinating how all of that is working. A couple other questions coming in. So does your team have a contingency plan, is the way it's put, in place for a recession? Do you see one on the horizon?
Yeah, so as I mentioned, we run the fund as I would describe us as very macro aware, but not with a strong forward view. It's not as if we take the fund and manage it for a recession that we think is going to happen. I would say, however, that given the value and quality tilt of the fund that I mentioned at the start, what that tends to do is provide us with really good margin of safety and downside capture. So if you look historically, the fund tends to do very well, in market drawdowns, which tend to happen during recessions or before recessions. So that sort of defensive posture is not because of concerns about the macro. It's really just how we invest and how we think about the opportunity set. So, I think that the fund will, continue to have that characteristic of strong downside capture, and then trying to keep up when the market rebounds, and through cycle generate, the goal is to generate strong relative returns with a lot less risk than many other mutual funds.
And just to sort of wrap up on what you think this fund ultimately would complement for investors that are already in the market, already have their plans there, just the sort of where does it fit question.
Yeah, so I think the fund is really unique in that, it's if you look at the fund consistently, it's much cheaper than the benchmark, but it's higher quality, and the volatility is also lower than most mutual funds. So I think in that respect, it's an uncorrelated alpha stream, and it's a really nice complement to many of the mutual funds out there, particularly the ones that are more, as I said, tech-focused, U.S. Mega cap tech names. So we think it's a great complement, and we're working really hard every day to try to find these unique ideas no one else owns, and try to continue to do our job for our shareholders.
Delighted to have this conversation and time with you. Thank you for joining everyone here today. Morgan, have a great rest of your week.
Thank you so much for the time.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. And while visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.